How to take money out of your pre-con condo investment? Stay tuned to this week's episode of Prime Props TV. Promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of Prime Props TV. So glad you could join us here. With the house almost complete, the fiance and I are going to full wedding planning mode right now. Thankfully, we have a lot of the big ticket items covered and we just got to wrap up the small but equally important details of the wedding. Now I can totally understand why people are totally consumed for a whole year about wedding planning. Holy, it's a lot of work. Well, a few weeks ago, Brandon brought up a really good question in a video that was posted. He asked, after your pre-development condo finishes and it's rented out, how do we reassess the equity in the property and get another loan to reinvest? That's a great question that most people may not understand the full details of, but I'm happy to break it down for you. Now, if you like videos like this, make sure you guys give this video a like and subscribe to the Prime Property channel where we'll be answering your real estate questions. Now, on to the answer. I love this question because of its very specific nature and it gives me enough context where I can actually provide some guidance. So first off, congrats to you, Brandon. It clearly sounds like you've made some money in the pre-construction market right now. Good job. I'm going to outline the steps you need to do and follow. It's generally fairly straightforward on how to pull money out of your pre-con investment. Number one, during the occupancy period, this is where you don't own the property, you're not on title, and you have no mortgage because you're not on title, so you just rent it out to a tenant when you get keys. Number two, on closing, this is when you get a mortgage based on the original purchase price that you made a few years ago. But make sure you get a variable mortgage. This is incredibly important because you want the penalty for breaking that mortgage to be 3 months variable only, which is what you get for a variable mortgage, not the penalty for breaking a fixed mortgage, which is around 10, 15,000, give or take. A simple calculation of how much your mortgage break penalty will be on a variable is every $100,000 of mortgage that you have, your initial interest payment should be around $300 or so. So if you have a mortgage of $400,000, then you're looking at 4 times 300, which is $1,200 per month. Then you multiply that by 3, and that's your penalty, which is about $3,600 to break that mortgage. It sounds like a lot of money, but if you really think about it, you're paying that much money to access an excess of over maybe $100,000. It's pretty worth it, if you ask me. 3, refinance that property at current market value to pull out the equity of for your next property. Simple, just 3 steps. A good mortgage broker should be able to execute that for you fairly easily. Now, I'm going to give you some tips and tricks to maximize the money you'll pull out of your property. When you're renting it out, again, depending on your situation, Brandon, could be different for you. You may want to give me a call for this, but it may be worthwhile to hold out on a higher rent than fill it immediately. This is because the higher the rents you have, the lower your TDS. And TDS stands for total debt service ratio. And this is for the banks. This is how they're going to qualify you for the amount of money you're going to get to take out on the refinance, which effectively gives you more money after the refinance. Again, this is case by case scenario and everyone's financial situation is different. Another tip is there are certain mortgage products that I can get on closing that will have a lower total penalty fee. I know Manulife has some products that change your loan to value ratio or LTV so that the total mortgage is less, therefore making the break less. Another option is you may want to consider, if you're not 100% sure you're going to deploy that equity right away, it may be worthwhile for you to use a HELOC or home equity line of credit against the property instead. This way, the equity is ready when you're ready to make that next investment. Again, speak to a good mortgage broker who has investment properties. Very key, has investment properties, so they understand this process and they should be able to plan it out for you. If you need one, reach out to me. I can connect to a few we use. And the final tip I'll use, this may be a little bit confusing, but follow me. There may be specific banks you want to talk to for your mortgage, and I'm not going to name the color or the bank's name, but because every bank evaluates rental income differently. So the property that you just got, that you put a tenant in, the rents you get are going to be considered differently against your rent ratios. Some banks will only use 50% of the rent you receive against your TDS. This means that if you own a condo downtown, say if it's 50% less rent on a $2,000 per month rental, that's $1,000 a month of cash flow that's going against your TDS. That makes a big difference if you're trying to maximize your refinance. Very, very key. Again, talk to a good mortgage broker. This week's episode was a little bit more advanced, but if it's something you like, make sure you let me know. I'm happy to do more advanced topics in the future. If you're looking to find a property and execute a strategy that Brandon has done and made some money, make sure you reach out to me. My contacts will be right here. There are still some pre-con condos that can do this, but not all of them are created equal. My contacts will be right here. Until next time, guys, happy real estating. We can answer a lot of your real questions.